There's a type of investment known as a mutual fund. Maybe you've heard of it. It's made up of a variety of stocks, bonds, and various assets. It's highly diversified, and it's sold to folks like you and me as a investment that you can purchase, and you don't have to worry about picking individual stocks and bonds and things like that. There are many videos out there that already go into great detail about what a mutual fund is, but I would like to talk to you particularly about a specific type of mutual fund known as a target date fund. If you work for a company that offers a 401k as a retirement savings account, a target date fund might be an investment option for that 401k. Similarly, if you have an IRA, an individual retirement account, a target date fund may be one of the options that you can use for your IRA. You can tell a target date fund from other mutual funds because some year that's way off in the future is within the name of the fund. The way a target date fund works is that over time, it starts off with these very risky assets, typically stocks that have wild fluctuations. But over time, as you get closer to retirement, it tends to move to less risky, less volatile investments such as bonds. Now, most finance YouTubers will mention the big problem with target date funds, which is that they can have high expense ratios. Over time, as the target date fund shifts its allocation from stocks to bonds, each time it's making those changes, it's incurring some kind of expense. Buying and selling stocks has some kind of commission fee, which is passed on to you. But there are other problems, and in particular, I find that there are two fundamental problems with target date funds that very few YouTubers actually talk about. Before I get into those two fundamental problems, if you could like this video, if you could comment, subscribe, I would really appreciate it, and it would help this channel out. Alright, without further ado, here are my two fundamental problems with target date funds. Now, I mentioned that target date funds will shift its assets over time to safer investments, which makes sense as you get closer to retirement. But here's the problem. The market doesn't care how old you are. The market, regardless of what sector, it goes up, it goes down, it's a pendulum that swings. Some sectors are going up, some sectors are going down, and all those things have absolutely nothing to do with your age. Yep, that's right. There's a fundamental problem about your investments when it's just based on you. There should be some reflection of the investment with how the market is doing. And as a target date fund starts to shift assets, it could be buying something when it's expensive and selling something when it's super cheap. This could be going against various investing principles that have been hammered into your brain by a bajillion other finance people. Buy low, sell high. But if a target date fund is just operating based on your age and it's automatically reallocating money, it might not be doing that. The buying and selling of any asset, stock or bond, should be reflective of some fundamental reason. The price of an asset should, in principle, reflect the value of the asset. And whether to buy or sell something should reflect whether or not its fundamentals have changed. Has the company actually changed? Is that why we're buying or selling the stock? Or no, it's just I'm just getting older and and that's why. That's the reason why. Fundamentally, I don't like buying and selling assets based just on me, but rather based on what's going on out there in the real world. This brings me to my second point, which is that your age is not equivalent to your risk tolerance. Risk is a highly complicated subject. It usually refers to talking about volatility in the market. How much volatility can you stomach, so to say? And what you can stomach depends on you. It depends on your own personal situation. Say you have two people who work the exact same job, they're getting paid exactly the same, but one person has a wife, kids, family, mortgage, and the other person is making the same amount, but maybe they're renting, they live alone, just by themselves, maybe with a oh god, that's me. The person who has a wife and kids and a mortgage can't take on the same amount of risk as someone who's just living alone, renting, and has a much more disposable income to really throw at the market, and if they lose it, it really makes no difference. For someone who has a wife, kids, family, and money's a little tighter, they need that money to really grow steadily. They can't take on as much risk. Likewise, if you're an older person, someone who's getting very close to retiring, but maybe you did very well off, the house is paid off, your kids are out of the house, and they're living independent lives. Really, you perhaps as a person don't even live off very much, but you've saved up a nice nest egg. You might be able to be a little bit more risky than someone the same age, but maybe they have more dependents or have not fully paid off the mortgage on their house, and maybe they haven't saved up quite as much as you have. Same age, very different risk tolerances. These two fundamental problems. Does that mean that you shouldn't get a target date fund? Probably not. A target date fund is still a very useful investment. And if you're the kind of person who just wants to put your money into a 401k, just have the automatic withdrawals from your paycheck, and it's going to a fairly safe, pretty conservative investment, then the target date fund might be good for you. But maybe you might be a more enterprising or aggressive investor, and you want to keep an eye out on your retirement, and you may want to be a little bit more active in your investments or the allocation of your stocks and bonds. Maybe a target date fund isn't for you, and you're better off actually investing a little bit more individually into, say, index funds and changing the percentage and allocation on your own based on your own risk tolerance. Either way, these are questions that you should talk to a financial expert about. These are things that you should bring up to them in discussions and not just keep them to yourself. I created this video so that you actually have a discussion point with a financial advisor. Don't let them off the hook. You're talking about something that is very important. Your retirement, your savings, your nest egg. This is what you're going to live off of for 10, 20, 30 plus years or something. I liken the retirement account to a child or your career. There are many important things in our lives, and your retirement account is one of those things. It's almost like saying, all right, I'm gonna have this child, and I'm just gonna give it some food, just kind of off to the side. I'm gonna check on it, every maybe once a year or something. Make sure it's doing good. And if it's doing good, it's like, okay, that's fine. That's great. But no, you're not going to do that with a child. You're going to check on it. You're going to raise it. You're going to make sure it's doing well over the course of time. You're going to make sure that it grows. You want to actively participate in the life of the child. And similarly, you should participate actively with your retirement accounts. It doesn't mean to necessarily be neurotically looking at your retirement account every single day, but to be active with something, a big chunk of money, a huge nest egg that is gonna make up what you're gonna live on for a large period of your life. A lot of people put their retirement savings just kind of in the back burner. They don't think about it actively. Really, retirement is important, and the amount of money that you're contributing to retirement represents not only time that you'll have in retirement, but time that you're dedicating to it through your work. You're putting in hours of time at work so that you have hours and years of time later in the future. Talk to your financial advisor. Ask them these questions. Don't let them off the hook. I'm not a financial expert. I'm simply trying to pass on ideas and wisdom and things that I've learned through reading, watching YouTube, general knowledge, and philosophy. I hope you found this video helpful. Again, please like, comment, subscribe. It really helps me out. And I've said enough. I'll see you soon.